So we have an estimated manufacturing overhead cost of $330,000. They tell us that in the problem. They also tell us they're applying the overhead, their allocation basis direct labor cost. And if the direct labor cost is $200,000, what is my predetermined overhead rate?
If your direct labor cost is 200,000 and we're using, oh yeah, so the predetermined rate would be, so what the book said is you actually, if it's in direct labor dollars, you use a percent.
Yes.
Materials cost, and I got 165%.
That's exactly correct. And so what you do then, when you apply overhead, you say, what is the actual direct labor cost? And you multiply it by the 165%, and that'll give you the amount that's applied. I want to emphasize that because people get used to doing machine hours and direct labor hours, and then all of a sudden they come across a problem where it's dollars divided by dollars. And you're absolutely right. Dollars divided by dollars, you get a percentage. You get a percentage. And since the estimated manufacturing overhead costs are greater than the direct labor costs, it's going to be higher than 100%. And that's exactly right. If you divide 330,000 divided by $200,000, you're going to get 1.65, or you convert it to a percentage, 165%. Your overhead is being applied 165% greater than your direct labor cost. Okay, very good. Thank you, Tyler. So A, raw materials purchased for $275,000. Pretty simple. You debit the asset, raw materials, and you can put raw materials inventory if you want, or raw materials is fine. And we paid cash, so we credit cash. In B, raw materials used in production, we used $280,000, but they broke it down. $220,000 was direct material costs. The remaining materials were indirect. So we had 280, so we debit work in process because that's the actual direct materials. For indirect materials, we debit manufacturing overhead. We credit raw materials. It's no longer in raw materials inventory. It got transferred to the direct material costs, got transferred to work in process. The indirect materials got transferred to manufacturing overhead. And that's actual. And we credit raw materials, no longer in that inventory account. Next, we we had paid cash to employees for the direct labors, $180,000, indirect $72,000, sales commission $63,000, administrative salaries $90,000. So the direct labor, we're going to debit work in process. The actual direct labor goes to work in process, debit that account. That's an inventory account. The indirect labor with the manufacturing, it has to be manufactured. So the indirect labor with the manufacturing operation is $72,000. The sales commission, that's selling and administrative costs. Sales commission expense, those are period costs. But direct material, we're going to debit work in process. Direct labor and indirect labor, when we have a manufacturing operation, the direct labor goes in at work in process. The actual indirect materials goes to manufacturing overhead. We debit it. Remember, we always debit manufacturing overhead for costs that are not direct. So if it's not direct materials or direct labor, then it's indirect materials, indirect labor. It could be depreciation on the factory building. It could be insurance on the factory building. Anything that has to do with the manufacturing operation. And if it's not direct material, direct labor, you're debiting manufacturing overhead for the actual. And then we have a selling cost. Selling costs are period costs, so we better see an expense. Sales commission expense. Administrative salaries have nothing to do with the manufacturing operation. We would still have administrators if we bought the goods already manufactured for us from China, right? We would still have that cost. It's an expense because it's a period cost. and then they paid cash, so you credit cash.
Hey, Ed, can I check my understanding with you real quick?
Sure.
Cool. So I was just because we started doing these journal entries, obviously we're able to kind of see how this stuff works as it actually is, rather than just obviously reading the the definitions in the book and whatnot. So with period cost, if I'm correct, they are recorded when they are incurred, and because they are incurred, they are going to be always recorded as an expense.
That is correct.
Okay.
So they're non-manufacturing costs. What are non-manufacturing costs? Selling and administrative costs are non-manufacturing costs. So non-manufacturing costs are expense. Non-manufacturing costs are period costs. Non-manufacturing costs are also known as non-inventoriable costs. So all those cost terms I mentioned in the first chapter, there's a lot to remember. That's why I keep saying you have to maybe go back and look at those definitions again when you come to some of them.
So the way that we recorded or journalized expenses in financial accounting is kind of how we should think about it as it is now with the period costs, just kind of because obviously we've learned the manufacturing costs are, these are new to us the way we're doing it.
Right. They're assets. You're building an asset. You're building inventory. Inventory is an asset. So if we're building motorcycles and then we sell them after we build them, all of the costs going into the process of building the motorcycle needs to be put with that inventory. And we have direct material costs. Those are easy to trace into a motorcycle. You can see tires, you can see fenders, you can see the engine, the tranny, all those things, right? And the direct labor is easy. You see who's working on the bikes. Those people working on the bikes, building them, they're the direct laborers. The supervisor walking around on the factory floor, solving problems. They could have problems with a piece of equipment. It's not working, their screw gun, or whatever. That's what the supervisor, they make sure production keeps going on as it should be. And when there's a problem, then the supervisor has to get involved. But the supervisor is not building the bike. Supervisor is helping those that are, like, oh, you need some more lubrication. Okay, I'll make sure that we get it. We get another 55 drum of lubrication that we use. That's an indirect material. So the supervisor goes ahead and makes a requisition to the raw materials clerk, and they get it over there, things like that. So anything that has to do with the manufacturing, if it's not direct material, direct labor, that's manufacturing overhead. And those costs are also put into the asset inventory. And the first inventory where we start building the product is work in process inventory. And then when we're done building it, it gets transferred to another asset, finished goods inventory. And then now we're right where we were in financial accounting, where we just bought things and sold them. They were manufactured by somebody else. We just bought them and sold them. So we didn't have any manufacturing costs. So that's what's different in this semester. You follow that?
Yeah, it's good that was a good explanation, because I've actually noticed there's quite a bit that's come together just within the last, just the first couple chapters we're doing with. I mean, there was stuff in financial accounting, just reading from the book, that was still, we hadn't gotten the full picture yet, because we hadn't gotten into, the manufacturing costs and all that, and how they're, kind of how we get them and stuff. So it's nice to see it all coming together now.
Yeah, so it's just the difference between a retailer that you're buying goods already made from a manufacturer. Manufacturer's building the product, and all costs associated with building that product gets debited to the asset account. And the work in process is the first place we start building it. And then when it's finished being built, it gets put into finished goods. So we would still, the finished goods inventory in the warehouse, and the warehouse clerk has nothing to do with the manufacturing process. We either buy it already made, you're still going to have a finished goods inventory, aren't you? And we're not going to call it a finished goods inventory. We're just going to call it merchandise inventory because we don't have raw materials. We don't have a work in process inventory. So anything that has to do with the finished goods warehouse, that's all selling cost. It has nothing to do with the manufacturing of the product. Okay, now where are we? Did we leave off with C? We did C, didn't we? Now we're on to D. We paid cash for rent during the year, $18,000. $13,000 related to the factory operation. The remainder related to selling and administrative. So the the rent on the factory operation, we debit. It's an indirect cost to manufacture the product. It's not direct material, it's not direct labor, so we debit manufacturing overhead $13,000. The rent on the selling and administrative buildings, that's a period cost, and we expense that. And we paid cash. In E, we paid for utilities on the factory. So those are all manufacturing overhead costs. That's the cost of manufacturing. It's debited $57,000 we credit. Manufacturing overhead, that's a temporary account, a clearing account. But now the advertisement has nothing to do with the manufacturing process. That's going to be a selling cost. So we debit, it's a period cost, we debit an expense, advertising expense. In G, here we have depreciation on the equipment. Total $100,000, $88,000 related to the equipment in the factory operations. So that's got to be a manufacturing cost. It's not direct material, it's not direct labor. So we got to debit the actual cost of manufacturing. That's not a direct cost, gets debited to manufacturing overhead. So $88,000 of the equipment that's depreciated. The other depreciation is a period cost. That's on the selling and administrative stuff. So we're going to debit depreciation expense. And we credit accumulated depreciation for $100,000 because you're going to have that equipment account at cost. And then every time you depreciate it, you're going to credit accumulated depreciation. But you're not going to debit depreciation expense if it has something to do with the manufacturing process. If it has something to do with selling administrative costs, it's depreciation, it's a period cost. H, manufacturing overhead costs applied to the job. Well, did they tell us what our direct labor costs were in the problem? Was it in C, $180,000? Is that right? It was. Look at transaction C. They tell us labor costs, direct labor is $180,000. 180,000 times 165%. That's what we calculated the predetermined overhead rate to be. So we're going to apply the overhead at 297,000. So we debit work in process. Remember, work in process is debited for actual direct materials, actual direct labor, but we're going to debit work in process for the applied manufacturing overhead. We applied it based on this percentage times the actual allocation base. The allocation base was direct labor costs. And they told us it was $180,000 times 165%. So we're going to apply 297,000 as our overhead. We debit work in process. We credit manufacturing overhead. That's right. Manufacturing overhead is credited for the applied amount. We debit work in process for the applied overhead. So students have a little trouble with this entry. Remember, when you apply overhead, you debit the work in process. You're putting in cost. We're estimating it, right? But we have our predetermined overhead rate. We multiply it by actual. In this case, the base was actual direct labor cost. So that's how we get the number. Any questions? You just got to remember which accounts need to be debited and credited. When we're done working on the product, and this is in letter I, goods that cost $675,000 to manufacture, according to the job cost sheets, were completed. When you're done working on it, no longer belongs in work in process. The goods are finished. You got to put them into finished goods inventory because now we're ready to sell them. They're done being manufactured. You got to reduce the work in process account because those costs get transferred from the work in process inventory to finished goods inventory. And then we're selling it. In J, they tell us what it costs to sell the goods we sold. Cost of goods sold, $700,000. Well, it's no longer an asset, finished goods. It becomes an expense. It gets expensed off in the time period in which it is sold. So the matching principle requires us to match the cost of goods sold with the sales. Our sales revenue is $1,250,000. We received cash for that sale. If we didn't receive cash, it was on credit, we would have accounts receivable, right? Any questions? Then they asked us to show the accounts for raw materials, work in process, finished goods. And they gave us the beginning balances. So you put that into the T account. And then you put in the transactions, raw materials. We acquired some in transaction A. In B, you put it into production, right? The $280,000 was split between direct and indirect. Direct went to work in process. So the $280,000, we had $220,000 that were direct materials. The difference, that $60,000, went to manufacturing overhead. See that? Oh yeah. The direct labor, that was simpler. It was $180,000, right? We applied the overhead of $297,000. We had a beginning balance of work in process. We had direct material costs, direct labor costs. We applied the overhead. Oh, we transferred out $675,000. So there's only $32,000 left. That's partially worked on products. The products that were completed got taken out of work in process and it went into finished goods. We had $40,000 of beginning finished goods. We completed $675,000. So we had a total then of what is that? $715,000 on this side. But we sold $700,000. That would leave only $15,000 of finished goods that's not sold. Very good. Here's the amount we applied to the manufacturing overhead account. Remember, we debit work in process. We credit manufacturing overhead. Here's our actual cost of manufacturing cost. Look, what we applied was $7,000 greater than the actual. So the actual, if we add this up, there's 10, 8 and 2 is 10, 7 and 3 is 10, that's 20, there's 8, 15, 16. Oh, 80, what's that? That would give us $290,000 if you add this up. Well, 290, the actual is less than 297, so we over applied it by 7,000. The simplest way is to close this out. We need to debit this account, and now it would be 0, and we would credit cost of goods sold. Now, what if we allocate it? Oh, yes, there it is. They debited the expense and credited the asset. And so manufacturing overhead is over applied, 7,000 for the year. So you got to close out the temporary manufacturing overhead account. 7,000 belongs there. Now this is zeroed out. See, by debiting manufacturing overhead, that would put 7,000 more there, and we'd have a zero balance. And cost of goods sold got reduced. It makes sense. If we over applied the overhead, that means we put into production 7,000 more of overhead than actual overhead. When you add this up, you only have 290,000 of actual overhead. We applied 297. So that means our credit side's larger. We over applied it. The applied side's greater than actual. We over applied it. That's how I remember it. If this was 300,000, if this added, then we would have under applied it by 3,000. So all you have to do is, which one gets debit and credit? Well, you just say, what do I have to do to get this account zeroed out? I need a debit right here. And so you debit manufacturing overhead, that gets a 0 here, and you credit cost of goods sold. Unless they tell you they want you to allocate it between which are the 3 accounts that you're supposed to allocate it to. Oh, work in process, finished goods, cost of goods sold. Income statement, that's pretty simple, right? Take your cost of goods sold there, 700,000. They made the adjustment because we over applied it. It's 693. So 700,000 was the cost of goods sold, but then we adjusted for the over application of overhead. We reduce it. So now our gross margin is 557,000. Here's all of our expenses. These are period costs. We subtract that. We get an operating income. Did anybody get this net operating income? Tyler got it. Good. Anybody else here? Let's see. There's Clarissa and Justin. So it's good to see we had some hands up. So I would say about half the people didn't get it. It would be wise to redo this as soon as possible. So if you don't have another class, I would get a blank sheet of paper and I would hide the solution and I would go ahead and redo it and then check with the solutions. Make sure I did it right. Is the way that you learn is through making mistakes. You want to make sure you redo it correctly. Because right now, if you got it wrong, it's in your mind. I did it, but I did it wrong. And then the test comes up and you're trying to remember how you did it and you only did it the one time, you're probably going to remember doing it the wrong way again. So you got to do it right. You might have to do it 2 or 3 times over to get it ingrained in your head. So practice is half the battle. The other half is knowing the concepts because we test both, don't we? We test both. Okay, any questions? So I'll be sending you the solution after I grade them. What questions do you have for me now? So is this easy or is it tough, this class? This is easier than accounting 255. Is that what you're saying, Tyler?
It's not easy, I'll say that. It's just a lot of practice. You got to make sure you practice a lot and you'll get it. But, you know,
Yes.
you got to kind of be able to sift through the book a little bit and apply it to the actual problems. But, I mean, once you do that, it's not too bad right now. I'll say right now because I don't know what's coming. So.
I'll tell you this much. A lot of people don't like to do the practice. And that's true about wrestlers, too. They don't like to do the practice. They just want to do the meets. But then they don't do as well in the meets because they didn't practice. So what am I saying about accountants that don't practice? Accounting students that don't practice. You got to do the practice. Right, Deshante? You know, you got to practice. All right, good. All right, then. I'm seeing people that I enjoy, but I'm seeing people for the second time around in here, and I don't like that. And they don't like it. So I just want to make sure they make it through this time. Don't worry, I'll be here next semester, but I hope you're not. It's not that I don't like you. It's I want to see you go on to the big U and impress those people. Impress them.